Hello, I'm Martin from Key Properties, and today's video we are going to look at calculating the return on investment on an investment property. Now that sounds simple, and it is simple, but as ever, experts complicate things. There are actually 4 ways of doing this, and you can wiggle the numbers a little bit to your advantage. So if you're looking at investment property and somebody's presented you a deal and you're not quite sure, then this is the video for you, because I'll show you the 4 different main ways of calculating the return on investment properties. I'll show you the 2 that are vanity metrics rather than sanity metrics, and I'll show you the 2 that most people don't look at so much but are actually the key ones. So we're going to look at ROI, ROCE, gross yield and net yield. Let's do ROI, the basic, simple, easy one. So return on investment, or ROI, is a measure of the profitability of an investment. It is calculated by dividing the net profit of the investment by the initial cost of the investment. So the net profit divided by the cost, and expressing the result as a percentage. The higher the ROI, the more profitable the investment. So calculating the ROI on investment property can be a particularly useful tool for us for determining the feasibility of a potential purchase and for comparing different investment opportunities. So the different metrics we're going to look at in today's video are ROI, return on investment, ROCE, which is return on capital employed, and we'll get into what the capital employed is later on. It's a brilliant metric for rental properties, that one. The gross yield and the net yield. These 2 here, gross and net, I think they are more vanity than sanity, because these are the 2 key ones. Most people focus on these, but actually these are super key. They're all important, they've all got their role, but these outweigh these every day of the week. And I'll debate anybody on that if you'd like to chat, so let me know. So just a little bit of jargon for people who are new to property investing. GDV is the gross development value. So if you have a property and you sell it for £250,000, then that is the gross development value. If you have that same property and you turn it into 4 flats, and those flats are worth £110,000 each, then your gross development value at that stage is £440,000. Each flat sells for 110,000 times 4, 440 grand. So the GDV is the end value of your project. So let's go back a step and look at ROI. ROI is return on investment. It is the net profit divided by the amount invested, expressed as a percentage. And we'll go through exactly how to put that together now. So here's a picture of a house that we completed long ago, number 9 Terrace Road in Swansea. We purchased it for £68,000. Sold for £131,500 after the renovation works. We spent £26,000 on doing it up. The total costs were £98,940. Now I know that the renovation value and the purchase price don't add up to that amount, but there were other costs. There are taxes, sales taxes, stamp duty. In this case, it's purchased at auction, so there's auctioneer's fees. There's all sorts of fees go on top. So you have to make sure you know the total costs, not just the headline costs, because the total costs are the costs that you actually pay. So total cost, £98,940. The profit therefore was £32,560. And then you can divide those together to get the ROI, which in this property was 32.9%. Now on a normal house flip, if you're getting 20%, you're doing well. And this one we got 32.9%. Very pleased indeed. There's lots of reasons why we do hit high marks with our flips. Location, choosing the right property, and you make your money when you buy, basically. So it's choosing the right property at the right time with the right works to do on it. And for more information about that, visit keypropertiesuk.co.uk and have a little look at our site. Reach out, contact me, book in a calendar call. So the next one is ROCE. ROCE is my favourite because we do a lot of rental properties, and this is how you calculate the rental value. So return on capital employed is the money left in after refinance divided by income from the asset, in this case the property. ROCE has funny names. It can be called ROCE, or in investment circles, ROCE. I just call it ROCE, but whatever you know it as or whatever you want to know it as, ROCE, ROCE, in the context of investment it's important, but in the context of property investment it can be used to evaluate the profitability of a specific property or portfolio of properties, and it helps investors understand how effectively the capital invested in a property is being utilised to generate profits. A high ROCE indicates that a property is generating strong returns on the capital invested in it, while a low ROCE may indicate that the property is not performing as well as expected. But however, it is important to note that ROCE is just one measure of a property's performance and should be considered in conjunction with other financial and non-financial factors such as location, property type, market conditions, and other things that can impact a property's ROCE over time. And it should just be one thing taken into account when evaluating a potential investment. But if you're going to pick one number, this is it. It's ROCE. It's the one number that means everything. If you had only one number on every property investment you ever did and you could only have one, it would be this, ROCE. So here's another house that we did. That picture's slightly on the wonk, I'll give you that. Just before this, when we finish properties, we book tenants into them and we leave them a bottle of wine and a card to welcome them in. Let's have a look. Lynn Street in Swansea, Kumbula area, this one. Purchase price £69,500. What do you think of these? This is a couple of years ago. I think the old white tiles were sort of in the they were the rage a couple of years ago. No longer so popular, but I don't know. Purchase price £69,500. Renovation value of £28,000. It had a valuation from a mortgage surveyor. It wasn't sold, it was valued at £130,000. This is where it gets interesting for ROCE. So the total costs spent on this property, including everything, were £100,940. Now, a buy-to-let mortgage, this is not a domestic mortgage, these are buy-to-let mortgages. They'll give you 75% of the value of the property. There are buy-to-let mortgages that will give you more, but do not look, this is how people get liquidated in downturns. Don't overextend yourselves, get 80, 85, 90% mortgages on your buy-to-lets. Have plenty of meat in there, because property over time goes up in value, and it does really, really, really well against any economy over time. But there's still moments, and the last thing you want to be is in negative equity with investments. This is your hard-earned money that you're putting to work for you. And when you're putting your money to work for you, there's no need to take undue risks with it. So 75% buy-to-let mortgage returns you £97,500 of the £130,000 valuation. Does that make sense? So I'm going to try and use a tool here. That there, 75% of that returns that. Whoops. How class is that? So let's move on. If I can exit this. Here we go. So the money left in the deal, therefore, is £3,440. So yes, to invest in this, you would have had to put £100,940 out of your bank account into the property, but the mortgage company has given you back £97,500. So the only money left in now, because that money is back in your account, this money here is back in your bank account from what was spent. So the money left in is £3,440. That rented for £750 a month. Our house was brilliant, actually. We turned it from a 3-bed into a 4-bed. And again, I'll tell you more about how we do things like that quite a lot by moving the structure of properties about. So when you've got rid of the mortgage and the letting costs of $416.25, you're left with a profit, and then you've got to get 100% of your money back, it will take 8.3 months. So yes, so the mortgage and letting costs, after the mortgage and letting costs, I have not made that clear. So after the mortgage and letting costs, the profit was $416.25 a month. So the mortgage, the interest only mortgage, is paid, and the 12% to a letting agent is paid. That leaves a net profit of $416.25 a month, and you get $416.25 a month for 8.3 months, and you have made back that money. And there, from then on, after 8.3 months, that property has cost nothing. All the money is back in the bank account. You have a property worth £130,000 in your possession. It will go up in value over time, and when it does, the 25% of it you own goes up in, so you get all of the uplift in value, if that makes sense. The bank owns 75%, you own 25% of it. But if that goes up to 150 grand, that extra 20 grand is yours. It's in your pocket. It's not the bank's, it's yours. And that's the beauty of property. It's a leveraged asset. Banks will give you mortgages on it, 75% of the value of the asset, and that allows you to have increased in capital growth as well as returns on capital employed. And when you use our model, which is to refurbish and refinance a property at a new value, BRR, it's called buy, refurbish, refinance, you can achieve phenomenal return on capital employed. This was a particularly special one at 145.2%. 100% is 12 months dead. 200% is 6 months dead. Obviously, this is in the middle. So that's, well, it's pretty cool, isn't it? Let's be honest. So gross yield. Gross yield is the purchase cost divided by the annual rent. So here we're back at Terrace Road in the bathroom. Purchase 68,000, all costs 98,940. Rent £650 a month, or £7,800 a year. The purchase price divided by the rent equals the gross yield, which was 7.88%. So the gross yield on this, 7.88%. You can quickly glance at that and go, that looks like it might be reasonable or not for what I'm looking for, and move on from there. But you can see it doesn't take into account the finance and the returns and all the other bits. It's just a basic percent, and it's very simple. And also it's gross, and gross hides so many things. You need the net. So let's look at the net. Purchase costs divided by the annual rent. Rent minus costs. So let's have a look. We're back on Terrace Road. Again, purchase 68,000, all costs 98,940, rent for £650 a month or £7,800 a year, minus letting costs equals £6,864 a year. Purchase price, or the purchase costs, sorry, including everything, divided by the rent minus the costs equals the net yield, and the net yield on this is 6.94%. So that doesn't take into account refinancing. It doesn't take into account anything that the mortgage company gives back. It doesn't take into account monthly costs from the mortgage company. It's just a basic percentage figure. So the net yield is phenomenal, and so is the gross yield. Gross numbers in any business you've got to be careful of, because they're overall numbers, and the net is the true value, the true number. And net in property is important. The net yield gives you a really good understanding of roughly what the rent is going to be in proportion to the value of the property. However, when you take into account refinancing, sales, things, that and the other, the two that really count are ROI and ROCE. So how do you calculate the ROI on an investment property? Well, the answer is on sales, where you flip a property, where you do it up and you sell it, or you buy it below value and then you sell it on. The figure to use is ROI, return on investment. If you had one figure to use, it would be that one. But if you're renting a property out, then it's ROCE, return on capital employed, all the way. Return on capital employed is everything. In rental properties, it tells you everything, and it's when you get 100% of the money back that you've put in. So you own that property for free and you've got all your money back, plus the income, plus the asset, plus the capital growth. That's the key number. And we do that every single day over at Key Properties UK, keypropertiesuk.co.uk. Come on there, say hello, book a calendar call with me. I'd love to chat. If you're interested in investment properties, that's how we do it. And we do everything from your basic level ones like I've shown you there, where it's simple, do up a house and revalue it and rent it out, to full developments where we're converting houses into HMOs, which is shared houses, conversions into flats, which don't think that's just like a renovation. You have got all sorts of fire regulations and sprinkler systems and access, and it's really detailed. It's incredible. And then we've got lots of other developments like that as well. So really nice you being here. I hope those have helped you, especially if you're new to property investment. Return on investment on sales, return on capital employed on rentals. I'll see you again soon. Ta-ra. Bye-bye.